Selling your business is a unique experience. You've worked years, decades, maybe even feels like a lifetime or two lifetimes in growing the value of that business, bringing on awesome employees, customers, building business lines that never existed before. And now to sell it, it's completely new to you. It's unique. And it's frankly, if you sell the business the right way, it's only one time you'll have to do it. So, what are some common mistakes that business owners are making before they sell the business? And the first one is really encapsulated by a famous Benjamin Franklin quote where he said, "Failing to plan is planning to fail." So, what we mean by that is looking to sell the business this year or next year. Instead, when we take time to sell the business and we think 2, 3, 4, 5 years down the road, making decisions today will have enormous impacts on not only the growth of the business, how prepared you are for the business, but finally, how well the sale will go. So what do we mean by that, practically speaking? When you're selling the business, a buyer is going to look for at least 2 years of financials when they're looking to acquire that business. They want to see financials for, if you're buying this year in 2026, you want to see the financials from 24 and 25. It's not good enough, though, for you just simply to have your financials and your tax filings completed. Instead, what we'd love to see is for you to actually have compilations completed for 2, if not 3 years of financials. The reason why you want compilations is compilations are essentially your financials with a bow on top. They're nice and tidy. It shows that your books and records are in order for not just the current moment, but for years prior to that. That allows a buyer to know that what they're buying has been recorded over time. The balance sheet is accurate, cash flows are where they need to be at, the assets, all these other things, right? It lets us know that we know what we're purchasing as a buyer. The other thing that's going to help you for it is going through that compilation will allow you to be able to quickly pull information that the buyer is asking for. And really what we're signaling here is we're telling the buyer, look, we have our ducks in a row. We know how to operate our business. We know how to go about making this sale occur. We know how to take care of business on our end. And it shows a buyer that you're more or less legitimate in your operations and in your finances. The second very common mistake that we're seeing business owners make is not uncovering all tax credits and planning opportunities early enough. So what do we mean by that? If you have a business where there's R&D tax credits, either at the federal or the state level, sometimes those will take a number of years for them to pay off. And what we'll see people do is they'll say, well, look, I'm selling the business in 2 years and those tax credits wouldn't hit until years 3 through 5, so I'm going to sell it. In reality, though, if you've applied for it and if you have things in good order, in years 3, 4, and 5, the new buyer is going to get the benefit of that. In all likelihood, that means that they're going to pay more for the business. And if they're willing to pay more for the business, you are receiving the value for the work that you did with those R&D tax credits. The third and final mistake that we're seeing business owners make in leading up to the sale is bearing expenses that the business could go without within the operational expenses. So what do you mean by that? There's really two things here. Use the example of an insurance claim. Okay, and let's say that you own a business and a hailstorm hits, you have a deductible of $20,000. You actually want your financials to show that in that year, there was a deductible claim of $20,000. You don't want to just bury it in your standard operational expense line items. When you do that, you're not able to make the argument to the buyer that that really truly was a one-off. But if you break it out on your finances, you're able to show that that was a one-off. So we want to have kind of like these recurring operational issues and then any one-offs that may occur. And the other thing too as well is we'll see this from time to time where people will say, for my business, we need a car. Let's say that we're in the construction business, okay? And people say, well, I really love this one type of truck. It's more expensive than the other ones. We have that one-time write-off. And then people, when they go to sell it, they're like, well, in reality, all you really needed was a 150 and I bought the 350, 450. And so the delta between that, you really should only be using the 150. In the 2 to 3 years leading up to the sale of your business, treat the business as the business. Those expenses that maybe could have been written off, or you went to a trade show and you decided to go to the trade show in London as opposed to the one in Cincinnati, treat the business as the business. When you do that, it is going to result in you having the true operational profits of the business and less what ifs, yeah buts, and kind of one-off explanations that you have to have along the way. Thank you so much for your time.